Hi, welcome to the Rule Based Trader and Learn and Earn with me. Free options trading for beginners course. In the last video, part 1 of options terminology, we learned very simple but useful terms, what are underlying assets and what precisely is a call and put option. Learn more about what an option chain is and how to read in option chain in this second part. So, what is an option chain? Simply put, it is the chain or list of all the available options contracts for a particular security. Either it can be a stock or an index. And please watch video number 2 in this free options trading beginners course to know what exactly is an options contract. So coming back, this option chain basically consists of call options, put options, their strike prices, volume and pricing information, and the maturity period, which is called as expiration date. And also more information like open interest and its change, bid and ask prices, implied volatility, delta, and etc. But as a beginner, let's learn only basics of option chain here. Aside, please watch video number 3 in this free options trading for beginners course, that is options terminologies part 1, to know what exactly are call and put options. In a nutshell, this is how a typical option chain appears. I have simplified a lot for clarity while keeping the fundamentals in mind. The underlying asset from which this option chain would have been derived will come first. It could be either a stock or an index. It would display the spot price or the most recent market price of the underlying item. The strike price located vertically in the middle of the option chain, whereas the call options are located on the left hand side of the option chain. The put options are located on the right hand side. The expiration date is located on the upper right or on the upper left whenever you open an option chain. Please take a note that as you move downwards, the strike prices are increasing. That's how an option chain is designed. The current market price of the underlying divides the option chain into four parts. In the money call option, out of the money call option, out of the money put option, and in the money put options. Call options that are in the money are those in the top left corner for which the current market price has already crossed. Out of the money call options sorry for that. Out of the money call options are those at the bottom left of the option chain for which the current market price has not yet been attained. Consider exactly the opposite for the put options. The put options that have already crossed the current market price are those in the bottom right corner. The put options at the top right of the option chain that have not yet reached the current market price are said to be out of the money. The option with strike price near or equal to the current market price is said to be at the money. So, on the left hand side and on the right hand side of the current market price are at the money, call and put options respectively. In the upcoming stages of learning, I will clarify what each of them means. Let's take a look of whatever we have learned on a real life example of an option chain. Here I have opened the NSE India website. It's a very vast website. There is so much of information in this website, so I will make a separate video for that. But in the interest of this video, let's go directly to the option chain. If you scroll down, you have to select this derivatives. Then you just have to select Nifty or Bank Nifty. The further options available, then I will tell you in some other video. So here if you see option chain, this all contracts, you can see other information. So for the interest of current video, I am going to take you to the option chain. If you see the time that I am recording this video is around 2:26 p.m., that is afternoon on a Saturday. So that's why if you see it is showing as the market is closed. So when the market has closed, that is yesterday evening 3:30 p.m., the Nifty spot price was 18,269. So this is how a typical option chain is looking. I am just scrolling it down and up just to get you a feel of this. As I explained you in my plain simply put option chain, here you will see the underlying asset, that is Nifty, the spot price, that also you can see. In the live market, this will be moving up and down, it will be fluctuating, and all these prices will be fluctuating. I am going to show in my next videos when I'm giving you a live trading sessions. So this is the expiry date. I'm going to quickly tell you what is this expiry date is. All these options contracts will have an expiry date. For an index option for which that I have selected, the Nifty 50, all the index options will have expiry of Thursday each week. Each week, every Thursday, all index options will have expiry. But for a stock option, the expiry will be last Thursday of the month. So if you see, these are the expiration dates: 22nd December, 29th December, 5th January. If I just open my calendar, you can see the 22nd December, 29th December, 5th January. These are all Thursdays. So every Thursday will be expiry for index options, and last Thursday of the month will be the expiry for stock options. If you see, these center vertically located is the strike prices of these options. You see this? On left hand side of the option chain is call options. You can see here call options. On the right hand side of the option chain, you can see the put options. And as I explained you, The current market price divides this option chain into four parts. If you see the 18,269 is the market price, you see there is a color differentiation on this portion and this portion, this and this portion. If you see, it is between 18,250 and 18,300. That is, this 18,269 is between these two prices. So this uh, strike price will not be same as the market price. This will be, I will tell you in my next videos how these strike prices are selected or predetermined. So suppose the current market price is here somewhere in between, and you see the strike prices are increasing as you go downwards. 17,800, 850, 900, 950, 18,000, then you go below, you'll get 19,000. So as you move downwards, the strike prices are increasing. So this current market price has divided this option chain into four parts. On the top left hand side portion, where I am showing you, this is called as in the money call options. On the bottom left hand side of the option chain, you see out of the money call options. Here, diagonally opposite to the in the money call options, you can see in the money put options, and diagonally opposite to the out of the money call options, you can see out of the money put options. So you please go to my options terminologies part 1 video, call and put options. You will get to know, you will get to understand what are these call and put options. So here you can see there are so many other terminologies as well. Open interest, change in the open interest, what is the volume of contracts that are being traded, implied volatility, the latest traded price or the last traded price, what is the change in this last traded price, the bid quantities, what is the bid and what is the rate, the price at which the bid and bid and ask of this LTP. So these are all for the call, it is separate. Again, for the put option, you can see all these values separately here. So this is how typically an option chain looks. In my next upcoming videos, let us get into each and every nitty-gritties of these terminologies, and as you go through deeper and deeper in options, it will be very easy to understand what all of this mean to you. In my next video on the option Greeks, I am going to take you through what is the intrinsic value, what is the time value of each option, and much more. So, what is the next episode in this video series? I am going to take you through the options grid, the option chain that I just shown you. That should have given you a general idea of what an option chain was and how it appeared. In this upcoming video, I will explain the option Greeks which have an impact on the price of the options contract. And here is a little standard disclaimer for you. And thank you so much. Please like, subscribe and share with the like-minded community of traders who wants to learn options trading. Thanks again.